Hello and welcome everyone today. We're happy to see all of you, all the practice owners and the administrators who have joined us today for our healthcare webinar. My name is Nicole McComber, a CPA here at Jones & Roth, and a firm that is dedicated to helping your businesses and practices thrive through proactive tax planning, compliance, and strategic financial guidance. At Jones & Roth, we specialize in supporting practices of varying sizes and complexities, just like many of you that are on the line today. Our team combines deep technical expertise and a practical understanding of the challenges healthcare practices face. Whether you're navigating new legislation like the One Big Beautiful Bill Act that we'll cover today, optimizing your entity structure, or purely just trying to work through the day-to-day pieces, preparing for audits, or trying to figure out how to implement tax impacts to you in your practice. Today, I'm also joined by Brian Newton and Jeremy Prickle. We serve as leaders of our healthcare and dental teams here at Jones & Roth. Before we get started today, just a little introduction to our firm, as we are one of the largest CPA firms headquartered here in Oregon. We serve clients across the Pacific Northwest. Many of our clients work closely with our team following a practice success plan. Our Jones & Roth Practice Success Plan is designed to offer practice owners, administrators, a value throughout the year, not just at tax time. So that helps you being able to maximize your financials, your operations, and the success of the overall practice, as well as the personal success of your owners throughout integrated tax, retirement, and financial management planning throughout the year. I'd also like to give a quick thank you to our strategic partner and sponsor of our healthcare webinar series. Law firm Watkinson Laird Rubenstein provides a broad range of legal services to healthcare practices. With expert knowledge of the complex regulatory environment, their healthcare attorneys help owners as they navigate the challenges of operating a healthcare practice. All right. So today, as we kind of dive in, we're going to be really kind of rolling up our sleeves and figuring out the One Big Beautiful Bill and how it impacts your practices. As always in all these presentations, we do want to make sure you guys are very aware that the information that we're presenting today is developed just solely by our presenters and does not represent any official positions, but also that here, and it's really deliberately and general in nature, because all of these pieces are very specific to your individual practices. And so we want to make sure you get enough of knowing what questions to ask, but please consult with a qualified CPA with your specific facts and circumstances to know how to best navigate through the One Big Beautiful Bill tips and key takeaways that we covered today. Before we dive in, let's just clarify one thing. What is the One Big Beautiful Bill Act, or what is HR1, or some of you might have heard it called as what is OB3. There's been a lot of names and acronyms, and so this was a major tax bill that was passed. It was through a major budget reconciliation on July 3rd and was signed into law on July 4th. Today, what we're going to focus on are several of the tax policy provisions from the bill that are going to extend, that extended a large portion of the Tax and Jobs Act's provisions that were due to expire at the end of the year, but also we're going to be looking at what are the adjustments that have been made to individual, corporate, and business tax, as well as some of the small pieces on the individual side as we have time at the end. So again, as we navigate through all of these, we do encourage you to use the questions section in the presentation box below. So as we dive in, what we're going to look at is with OB3 or OBBBA, you'll hear it acronymed a few different ways. That, you know, the provision from the TCJ Act that we're set to expire and phase out. But a few of the key things that we're going to hit on today is we're going to start on the business provisions and make sure, you know, as we walk through these, you know, what are some of the things we can do today and tips and tricks that you can pull in. But one of the very first ones on the list is always a hot topic, especially as we approach year end. But we'll quickly go through each of these today and give you a couple takeaways. So Jeremy, let's dive into the key topics.
Sounds great. Thank you, Nicole. The first one that we're going to talk about today is the capital expenditures. And as Nicole mentioned, a lot of these come about at year end as you're trying to minimize taxable income. And so the concept of depreciation, it's hard to believe back in the day, Section 179 started at $2,000. So if you purchased a piece of equipment, computer equipment, desk, chairs, things like that, the IRS would basically limit how much you could deduct of that purchase. And the limit was $2,000 back in 1958 when Section 179 started. Since then, we've had increases in Section 179 all the way up to the point of prior to the OBBBA of 1.16 million. And so we were concerned that that might go away or be reduced significantly. Under the OBBBA, that's been increased to $2.5 million. So for all of those worried about that, you can purchase up to 2.5 million and expense that in the first year. You may also be wondering about bonus depreciation. That was the big one we were really worried about, as that was being reduced every year and expected to be reduced to 40% in 2025, and then further to 20% in 2026. And then we were expecting bonus depreciation to go away completely. The good news is that we have had permanent restoration of the 100% first year bonus depreciation. That is effective January 19th of 2025. So that's all been very, very good news when it relates to capital expenditures. I don't think many of you on this call will come up against this limit, but there is a limitation once you get above $4 million of purchases on that Section 179, where it does get reduced dollar for dollar above that. So just something to be aware of there. But again, good news when it comes to capital expenditures. We're going to be able to continue depreciating and expensing capital expenditures into the future. Just a brief note on the difference between bonus depreciation and Section 179. The major difference there is that Section 179 will not allow you to take your deductions into a loss position. So in other words, let's say you had $50,000 of taxable income and you had $60,000 of purchases. The most you could deduct in Section 179 would be $50,000 to bring your income to break even, whereas bonus depreciation would allow you to generate a loss with respect to your business income. I also like to just mention that you want to be careful in taking bonus or Section 179 depreciation, accelerated depreciation, especially if you have financed the purchase of that equipment, because it basically creates a timing issue with respect to the cash flow of that purchase versus the expensing of that asset. So be aware of that. Make sure you're talking with your tax advisors on that, because it's very important to make sure you're timing those deductions appropriately. Okay. The next one that we're going to talk about today is the pass-through provisions. It's called Section 199A, but most of you probably have referred to this as the qualified business income deduction. The qualified business income deduction is essentially a 20% deduction on any qualified business income deduction. And we could probably teach a whole day class on this section 199A, as there's a lot of different limitations with respect to it. But essentially what it was is a 20% deduction on qualified business income deduction. That's mainly pass-through income, so partnerships, S corps. This was set to expire at the end of 2025, and it has become a very, very big deduction for a lot of businesses. And folks have gotten used to getting that deduction every single year. And so as we approached the end of 2025, we were concerned from a cash flow perspective what this would do to people's taxes. So we were pleased to see that this was extended under the OBBBA, and it does make that QBI deduction permanent. And it also widens the deduction limitation phase-in range. So there is an income limitation where this gets phased in. In 2025 for single taxpayers, that phase-in range is basically 197,300 to 247,300. So that gap between those phase-in ranges was 50,000. And then for married filing joint, that's 394,600 up to 494,600. And starting in 2026, that phase-in range has been increased to 75,000 for single taxpayers and 150,000 for married filing joint. So the limitations in 2026 go to the beginning phase-in range for single is $201,775 to $276,775. And married filing joint, that limitation goes to $403,500 to $553,500. It is important to know that there is a cliff for what are called specified services, trades, or businesses, which is pretty much all medical practices, dental practices, also for attorneys and accountants just like us. So unfortunately, once your income gets above those thresholds, you are losing that deduction. And if you get to the top tier of that phase-in range, then you will be completely phased out or eliminate the threshold. If you're not a specified services trade or business and you go above those limits, then of course you lose a portion of it based on your wages and your and also any of your qualified property. So just some limitations there. We're very excited that this is still in effect. Another one of the pass-through provisions is the SALT limitation, which refers to the state and local tax deduction. As many of you know, they implemented a SALT cap on your personal tax returns. That SALT cap is $10,000. So if you have state and local taxes that are over $10,000 individually, the IRS is capping your deduction at $10,000, unfortunately. And so what happened is states ended up passing laws. Well, there's 36 states that passed laws that basically allowed business owners, pass-through business owners, S-corps, partnerships, to essentially take and pay the taxes associated with that pass-through income at the entity level, which essentially bypassed the itemized deductions at your personal level and allowed you to take a deduction at the business level. So we're very pleased that this has stayed in effect, and pass-through business owners can continue maximizing their state tax deduction using this election. It's important to note that this $10,000 cap or 10,000 SALT cap is expected to return in 2030. They basically increased the state and local tax deduction on your itemized deductions from 10,000 to 40,000. And so we were concerned that they might remove the ability for pass-through business owners to deduct that pass-through tax at the entity level. We're pleased to note that that is still being allowed going forward. So not only do you have that increased state and local tax deduction at the individual level, but you can also still take advantage of the salt deduction at the, or the pass-through tax at the entity level. All right, Nicole, I'll let you talk about the research and development expenditures.
All right, so this slide may not apply to all attendees, but if it does, it's a pretty massive planning piece that you should be aware of. And there's some timely parameters to address if this applies to you. So historically, kind of the history on R&D or research and development was that historically business could fully expense when they had R&D cost under Code Section 174 in the year that they were incurred. However, in the Inflation Reduction Act, that got changed in 2022, which required businesses to capitalize the R&D expenses over 5 years if it was expenses incurred domestically, or 15 years for expenses that were sourced from foreign sources in payments. What happened was, even if the project was unsuccessful, it didn't fruition to anything, it didn't end up coming out with a new product or a software or whatnot, is you still had to amortize those expenses over a relatively long time period, 5 to 15 years, while the cash flow is already out. This change significantly increased taxable income for many businesses and practices that do have R&D, especially startups or kind of those initial, when you're rolling out a new product or software, and created a big book tax difference and some complexities for tax planning for practices that it applied to. Big change under the One Big Beautiful Bill Act was restoring full expensing of R&D cost, and it went retroactive. So this bill passed in July, but retroactively back to January 1st, 2022, saying, hey, we're going to go back to full expensing in the year incurred. So there's some very strategic positioning depending on the size of your practice, where your gross revenues are, of deciding, well, how am I going to go back? Can I go back and amend for 22, 23, possibly 24 if this didn't come on your radar before you finalize 24 taxes? So do some strategic planning if it applies to you, looking at timing of where you want those catch-up deductions, whether it's amending or doing some catch-ups in 25, 26. Kind of put this on your list as a dialogue. Those of you that have R&D, or if you haven't explored it and think you might, it's a great conversation and topic to explore and address for practice planning for sure. The other one is interest expense limitation. So those of you that have been subject to limitations on how much interest expense you can deduct, those of you know who you are, because it's kind of a painful transition when we went there. The calculation has returned back to an EBITDA calculation, so earnings before interest, taxes, depreciation, and amortization, with no expiration. So what happened when these rules came on board is we started with an EBITDA calculation for determining how much of your interest can be deductible, but then there was a phase into less favorable, and the more favorable than the EBIT. So they removed depreciation and amortization add backs. That for leverage practices took a big impact. It was creating some large carryovers and excess interest that we weren't able to deduct. So if this applies to your practice, it's a good time, not only one, kind of look at your planning, because you might have some deductions that previously had been limited that aren't going to be as limited, but a good time to look and reassess your financial structures to maximize your deductible interest as well. So another one to kind of tuck in if this applies to your practice. Brian, can you tell us a little bit about some of the payroll changes that we need to think about that have created some questions for practices?
Thanks, Nicole, appreciate it. Before I jump into the payroll stuff, I just had a couple of additives to the PTE, pass-through elective tax components, and the depreciation stuff. Especially in Oregon, we know for sure, but other states possibly as well. It's a good reminder there that the treatment of pass-through entity income is different in some cases when you use bonus versus Section 179. For example, in Oregon, oftentimes you're maximized by doing 179 because it increases your PTE tax, which increases your federal tax benefit of deducting those taxes. So, a lot of information there, but in the end, that's one you don't want to just take the easy route and coordinate with your tax preparer to discuss what's optimized in those positions you take as it relates to 179 versus bonus, because initially it seems 100% is 100%. What's it matter? So just make sure that you're being a little bit more diligent on maximizing utilization of those different options. And then similarly, when we look at PTE tax optimization, I still see pretty oftentimes our healthcare providers have a tiered entity structure with a partnership as the operating entity, with maybe individually owned S corporations underneath, and then down finally to the provider themselves. I still see pretty frequently, it seems, that election for the Oregon or PTE tax is made at the S corporation sub level instead of the operating level. So that's also something to be aware of and evaluate with your tax professional, as optimization of which entity potentially is claiming that PTE tax position. All right, so I get to talk about payroll changes and really the headline items of the OBBBA. I hate saying it 3 times, so I'm going to maybe say OBBA because it comes off the tongue easier. The first item I'm going to chat about is the paid family and medical leave credit. This has been around for some years now, but it's been pretty widely unutilized, and I think because of a lack of awareness of this credit and communication, because it can take a little bit of digging and additional information providing to your tax preparer to make sure it's captured. Prior to OBBBA, the credit was 12.5% of 25% of leave wages. What the OBBBA has done is permanently extended this credit opportunity and also provided for a little bit more robust potential credit, and in some cases made it a little bit easier to create eligibility for the credit. So the new credit, which starts in 2026, is a minimum of 12.5% of 50% of leave wages, up to a maximum credit of 25% of leave wages paid. That credit percentage increases based on how much over a 50% of normal pay payout is accomplished, kind of on a prorated perspective. So the more you pay out in leave relative to normal pay, the more you're eligible for credit determination. To qualify, you also have to have a written policy for your family medical leave. There's a good number of requirements. The 2 I'll highlight for you because they're the most tangible probably, is that there is a minimum of a 2-week payout of family leave and a minimum of 50% of normal comp payout to be eligible. It can go upwards from there, but those are the minimums. So the takeaways on this, I think, are make sure that you take a look at your policy, your written policy, and compare it to this requirement if you have a family leave policy, to see if it's eligible or close to, and make the tweaks necessary to make it eligible. And then also communicate again with your tax professional. Be proactive if you have a leave program of communicating what that is and your numbers basically for your tax year of the leave paid and eligible. One other just subtlety reminder: PTO, normal PTO vacation time is not includable here, right? This is just for actual leave requirements, so you would not be able to take this on normal PTO vacation sick time. My next topic is the no tax on tips. So this, of course, was huge in the headlines initially when things were kind of out there. It was an extreme consideration of just purely no taxation on tip income possibility. What's happened in the final bill is a temporary deduction up to $25,000, which does have income phase out. So the most you can deduct is $25,000 as a taxpayer. It does phase downward of a deductibility at $300K for married filing jointly filers, all other filers $150K of income. So the outcomes of this means if there is some tip component, that you're aware of or to yourselves, that you would want to capture that information and be aware that you're still going to pay FICA, Social Security on that, or the employees will. Probably not broadly applicable as an employee side here, but if you do have, a spa component of what you do, aesthetics, maybe there is some tip income. So your employees might be coming and asking questions on these topics about reporting here to take that benefit potentially of a deduction versus just purely tax-free income on the other side. Other thing related to tips, which could be important to know, especially for those of you that might have some tip component to your provided services. Again, most common might be something like aesthetics or spa treatments, is that we've had for a long time an employer credit that is related to tips that's been purely for restaurants and food service historically. Starting in 2026, I want to make sure I have that right. it says 2025, they've expanded that provision to be allowed for beauty services as well. So again, in those kind of named items, if you do have that, you'd want to be communicating, sharing, and tracking the tips paid, because the employer might be actually now eligible for an employee tips credit in those potentially rare circumstances in this industry. Now I'm ready to move on to the next one. Nicole, thank you. On the overtime side, again, the other big headline item in the OBBBA was the idea of no taxable income on overtime pay. It kind of came to fruition very similar than the no tax on tips, and probably this one is more applicable to this group here as far as having overtime pay existing in your practice. But this similarly has a cap to the amount that is deducted instead of just being no taxable income. So overtime will still be subject to FICA, payroll tax, Social Security, Medicare. The cap here is $12,500 for single or all filers other than married filing joint, which is $25,000 is the max deductibility of overtime pay. Same phase out ranges that could reduce the deductibility of these items at $300,000 for joint filers, $150,000 of all others. Both this and the tax are adjusted for inflation to move upwards starting in 2026 and beyond, and both do have a non-permanent provision, so it's right now set up to be 2025 through 2028. One of the key items, if we move to the next slide on the overtime pay, is that the eligible overtime pay for the deduction is only the excess or the additive pay over normal pay. So the math there can be a little bit less than simple. If you have employees that are being paid overtime, what would apply potentially for this credit is the amount paid over normal, not all overtime pay paid, but the excess that's paid over that would be eligible potentially with those limitations included. We note here must be reported on W-2. That is a little bit dated. That was anticipated. The Treasury has indicated that for 2025, for administrative reasons, we believe primarily, they will not be changing the W-2 form. So that line is potentially and likely moot for 2025, and maybe more supplanted by having the information available to provide pay stubs or information on overtime pay supplementing a W-2 for tax reporting. Because there's not necessarily, and it doesn't look like going to be a place to put it, at least on the 2025 W-2, as a separate disclosure amount for the use of the employees and others that might be in a position to take opportunity of this deduction for overtime pay. Finally, important too to be aware of on both the no tax on tips and the overtime deduction components, you can't double up on these. So a taxpayer that has a component of both will have to be aware that there isn't an ability to take the additive, 50,000, but you're essentially globally capped to 25,000 deduction in total when you combine the two. One other tips aside, just in case there's folks out there, with dependents or kids, the tip component has to be voluntary to qualify. It can't be mandatory tips. So that's really set up, I think, to avoid abuse by employers or others with creative ideas to go, well, I'm going to charge 80% and do a mandatory tip of 20% to try to qualify for this opportunity. Unfortunately, in the provision, they did put that it has to be voluntary. So, if you know others in food service or tip industries, you could share your knowledge because, I talked to my daughter, for example, who works in food industry right now, and told her if your restaurant, your employer currently requires tips for large parties, maybe have a conversation with them about removing that requirement, because that might be falling out of this provision. Because of the language in the bill being that it has to be voluntary and cannot be mandatory tips. So good to be aware of those slight provisions. I'm going to try to go quickly through this item. Again, probably not a ton of applicability, but important to have awareness, I think, especially for those that, on the investment side where these things might play into the audience today. Opportunity zones, at a quick summary, was put into play through the Tax Cuts and Jobs Act some years ago. And essentially, it's an opportunity when you have capital gain income to recognize or realize. It's a reinvestment opportunity into what's called a qualified opportunity zone fund or qualified opportunity zone, to be able to potentially defer some tax, as well as on the very long end, potentially avoid some tax. So the trigger points here for the listeners would be if you have a capital gain opportunity that's especially substantial, you might explore this a little bit further. But what we have found over the infancy time of this being in existence is that it's really come most through investment activity. You can't just simply find a zone that has a qualification as an opportunity zone and go buy property there and qualify. It has to be through a fund, which oftentimes comes in the form of, you know, investment groups offering investment opportunities. What the change has been through the OBBBA is, again, permanently extending the opportunity zone provisions, where before it was due to sunset, I believe after 2025. The other item it did change is there's a 5-year and a 7-year provision on this opportunity. Starting in 2027, only the 5-year component will continue to apply, which is your original investment after 5 years avoids 10% tax on the gain if you hold it. And then you get another 5% on top of that for a total of 15 on a 7-year hold. That secondary layer will go away in the relatively near term, and it'll only be that 5-year provision. It is interesting that we're coming right up at those years, that 7-year period for tax surprises for folks who formerly utilized these, because again, on this opportunity, you will have the taxation hit in year 5 or year 7 or before, depending on certain circumstances. It's just deferred. The real opportunity of benefit in the long run is your new investment has opportunities of appreciable tax gain avoidance with a 10-year or further hold. So where again, you might look at this as through like more of a passive investment type of opportunities in most cases where that comes to play when you have a capital gain event happen for yourself. The other provision on this slide is the qualified production property through the OBBBA. It's pretty extreme as far as opportunity, but the applicability here is having a facility that manufactures and creates tangible product can, in certain cases, in the nearest term, allow for 100% full bonus depreciation of factories and improvements, which is, you know, pretty big in those situations where that does apply. So in the off chance or the limited chance someone here has, you know, a production facility or is exploring something like that, this is something to chat about and learn more details about. Or again, you know, this is a little bit professional assumption or opinion. Maybe in the next half decade or so, there might be investment opportunities that this translates to, with, you know, investment groups saying, hey, we have this great new investment opportunity where you get a big deduction of bonus depreciation on the front end because it qualifies for this provision. There can be all sorts of limitations on depreciation in your circumstances, so obviously be very careful in those kinds of things, but that's at least where this might come into play as future you know, solicitations of tax efficient investments, those kinds of things. And my final topic is on 1099 reporting. Super fun stuff, not super fun, but can be very relevant. The OBBBA starting in 2026 has increased some thresholds finally on 1099 reporting, which is a welcome sign under the $600 rule we've had historically. So again, it's not changing for 2025, but you'll want to look to 2026 awareness and changing kind of, you know, your accounting software for identification of requirements to issue 1099s. 1099Ks thresholds has gone up to $20,000 and over 200 transactions. As an issuer of 1099s, probably not very applicable to this group because that's going to be your, you know, your merchant service vendor type of 1099 activity. But on a receipt basis, you might see this come into play in getting fewer 1099Ks issued to you in the future. The more relevant for this group is issuers of 1099s is going to be the next 2 bullet points. For 1099 non-employee comp, that's going from 600 to 2,000. So a nice increase there on a per vendor basis. And similarly for miscellaneous 1099s, 600 to 2,000 starting in 2026. These are also adjusted for inflation, which is a nice welcome sign as far as it not being a stagnant number and moving along with cost of living and other adjustments and inflationary adjustments. So it's good to be aware of that on the front end, because that could mean starting in 2027, you need to actually continually pay attention to these numbers and update your systems accordingly versus just sitting on the same number for, you know, years and years and years like we have for the $600 amount. Now, I think I'm kicking it back over to Nicole.
Yeah, so some quick hits there. I know a mouthful and informationful to kind of take away with, but at this point, we're going to pivot to the individual provisions. So as you can see, the business level, there is a lot that's both 2025 and 2026 kind of radar, making sure incorporating. So let's pivot to some of the personal, because at the end of the day, especially with these pass-through entities, really to plan comprehensively, we also consider what's happening when it flows through to our owners, both to achieve proactive planning, but also to really make sure we're accomplishing some intentional tax positions. So Jeremy, I'm going to let you walk us through some of the quick list of things on the individual side before we close today and go to questions.
All right, thank you, Nicole. Okay, so on the individual provisions, there's quite a few things, again, that we were really concerned about with the expiration of the Tax Cuts and Jobs Act provision. Many of those things were slated to go away. And then we're pleased that with OB3, or I still struggle with what to call this thing, but the One Big Beautiful Bill, or I'll refer to it as OB3 from now on. Under the old law, we were expecting that all of those reduced tax rates that were with the Tax Cuts and Jobs Act were set to expire at the end of this year. And then all of those rates were essentially going to go up about 2% across the board at each level, had nothing been passed. And so with the OB3 provisions, we now get to enjoy the permanent extension of those reduced rates. So that's good news for all of our individual taxpayers that are going to enjoy those lower tax rates going forward. The other big one was the standard deduction. I don't know how many of you recall, but prior to the Tax Cuts and Jobs Act, those standard deduction were $12,000 for married filing joint and $6,000 for single, which meant quite a few people were itemizing their deductions, and those are now at $31,500 for married filing joint and $15,750. So that's for folks that have, very low mortgage interest or low other deduction. They're going to be able to enjoy that standard deduction at that higher level, which essentially saves them taxes. Another one is the SALT deduction, state and local tax deduction. I kind of referred to this earlier, but the Tax Cuts and Jobs Act introduced a $10,000 cap on state and local taxes, and that was set to that SALT deduction limited to $10,000 expired after 2025, which meant we would have been going back to those old rules again, the lower standard deduction, etc. That SALT deduction was increased to $40,000 in 2025, and we have inflationary increases through 2029, but this one does return back to $10,000 in 2030. So we'll see what happens at that point. It is important to remember that if your income is over $500,000, that $40,000 SALT deduction cap does get reverted back down to $10,000, which is why we were really pleased to see that on the business side, we're still allowed to use the pass-through entity tax deduction at the entity level, because many physicians, doctors will be over that $500,000 cap, in which case they're still being limited to that $10,000 SALT limitation. So again, really pleased that they did increase the $40,000 SALT deduction limit, and also the standard deduction. Another one that is new to the OB3 is the personal interest on car loans. Historically, we've never seen a deduction for personal interest on car loans unless it was like a home equity loan, etc. They have now allowed a temporary deduction up to $10,000 between 2025 and 2028. Again, it's important to remember that this one does expire. This is only for new cars and ones that are assembled in the US. And there's also a phase out above 200,000 married filing joint, and 100,000 for all others. So again, this is a new one, and if you have a car loan, you might be able to benefit from the interest you're paying on it. So that's great. On the deduction for seniors age 65, this is also a nice new thing for seniors. There's a temporary $6,000 deduction for each taxpayer. Again, this is between 2025 and 2028. This does have a phase out above $150,000 for married filing joint and $75,000 for all others. So again, really some nice tax breaks there for seniors. Nicole, I'll go ahead and kick it back to you as we wrap things up and open the things up for questions.
Thank you, Jeremy. So as we had our short time together today, it was a very full agenda, and we don't expect you to have mastered any of these, but ultimately just making sure that we've planted a few seeds to help you be more informed and make intentional and strategic decisions as you wind down the year, but also as you're going into your planning mode for next year. As I always tell my clients, we don't let the tax tail wag the dog by itself, but we certainly don't want to, we want to make sure it's not forgotten about. And our goal here today was to give you a few quick hits on those key points so that you can be intentional in your planning. And hopefully you learned something today to help manage through preparing for year end and for setting your goals and budgets as you go into 2026 with the vast amount of changes that have hit. I know for me, the ones that I keep hearing about, Jeremy started with capital expenditures, what to do, how to expense it, do we get it done before year end or not? PTE, do we need to get that fourth quarter paid before the end of the year? Where are we at? Are we penalty proof? So a lot of pieces there. And as you can see, those tax changes, both at the business and at the individual level, a little bit hard to kind of say, well, things are the same as last year, so taxes should be the same, because there's actually been quite a few tweaks in there. So really encourage you to work with your advisors to make sure you're implementing and knowing how it impacts you directly. So with that, Sarah, let's shift to any questions that have come in today.
Sure, and we do have some questions here. The first one is, must QOZ investments be registered when the investment is made, i.e. document the investment as a QOZ?
Yeah, so Brian, I don't know if you want to jump in on this one. Proactive in front of it planning is actually pretty critical. Discovering after the fact, we have doors that start closing. So Brian, do you have more flavor to add there?
Yeah, well, I think the key on that one is if it's something you're exploring, absolutely seek the proper advice and discussion points. I'm not, and I don't know if any of us are absolute QOZ experts offhand. The things I know of offhand are that technically it has to be registered and accepted, I believe, as a qualified opportunity zone fund. So in other words, eligible investments for the deferrals and the avoidance of gain opportunities potentially hinges on not only, I think it's 90% or more of the property improvements have to be inside a qualified opportunity zone, but the entity structure itself has to proactively apply and be considered and qualify as a qualified opportunity zone fund. So where you would look into more details per that question would be around the qualified opportunity zone fund component requirement that I think is where basically what drove the infancy of this provision of being something that seemed like it might be a huge, easy, quote unquote, opportunity when it was first indicated into something that's quite a bit more difficult or challenging to do kind of unilaterally versus through an actual investment group or a larger group that is developing these types of opportunities for investing on a more passive basis, we'll call it. So, I mean, that would be my best, at least, recommendation is, you know, vet that out a lot further and in advance, because it is something that isn't as straightforward as kind of a Google search will let you know about.
I'd also, Brian, I'd add a couple notes on that too. The first one, as I've had clients that have done opportunity zone investments, the first thing that I would mention is that the first inclination is that opportunity zones are in areas that are not nice areas. And I would tell you there's quite a few. If you look, you can go online and look at the qualified opportunity zone map across the country. And I think what you'll find is you'll be surprised at the areas that qualify for qualified opportunity zones. The second thing I'd add to that is that remember that the first benefit that you get is on the first gain. So for example, let's say you sell a stock or you sell another piece of property and you have a capital gain. Let's say you have $50,000 of a capital gain. The benefit on that first tier is that you're going to defer the gain for 10 years, in which case you will eventually have to pay the taxes on that $50,000. So you don't eliminate that gain, but the benefit is on that new $50,000 investment. As long as you hold that for that 10-year period, then now you pay absolutely no tax on that gain on that new $50,000 investment. So if that $50,000 investment goes up to, say, $1 million, that gain between $50,000 and $1 million would be tax-free at that point, as long as it's invested in one of those opportunity zones. So a really great opportunity if you're in that situation.
Okay, next question. If I order my equipment by the end of the year, will I get my deduction?
So that's a great question. It comes up all the time. It's important to remember that under those capital expenditure provisions, you are required to actually place the property in service. So it's not good enough that you've ordered it. It's also not good enough if you've ordered it and it's arrived. It must be actually placed in service according to the technical guidelines of the law. So it is important to make sure that you're not only ordering the property, paying for the property, but also placing it in service.
Okay.
I think where that emphasizes is, as you guys are looking, if there are still purchases to accomplish before year end, really pushing those timelines, looking at the shipping and making sure it can get that box is open and it's available and ready for use.
Okay, next question. It's a big one. How will this government shutdown affect the new tax bill?
We've had that question quite a bit. So as we know, there's a lot of provisions that changed, and we also know that the government has had cuts throughout the year as well. And so the IRS has been working through updating forms, but with the shutdown, we fully do anticipate what this could do is delay forms getting finalized. Ultimately, what that could mean is it might delay when we can hit the e-file button and actually submit things. But really, for all of you on this call, and for each of us as advisors to our clients, we're planning as normal, closing down the books, getting things in place, and working through. If there's a delay in filing, doesn't mean we can't start. And so we'll be watching those closely. No, we're looking to see what forms need to be approved, but we fully do anticipate anytime we've had big tax law change, it typically can delay things. It's not months, it's usually weeks from what we've seen in prior years, and just seeing when they come online. And I do give grace of that once those changes come out, we might find issues on the forms at first. And sometimes when that's happened, we've had to push it back up the pipeline. But that's what you have professional advisors doing the worrying for you in that stake.
And on that note, that's the end of our questions.
Awesome. Well, thank you everyone for joining us today. We hope you found this session valuable. But do also invite, if you have questions or things that you thought about after you leave the call today or want to explore any of these further, please feel to reach out to one of us or reach out to your advisors just to make sure that you're getting your goals accomplished and making sure that you're getting the right guidance along the way. So thank you everyone, and have a wonderful weekend.